Michaela, at the moment, are you telling clients to increase risk exposure or reduce it?
So over the past couple of months, we've been thinking about adding a little bit more risk, but avoiding an extreme, avoiding adding too much risk. So we've been thinking about being a bit more neutral, stocks versus bonds, about adding a little bit more risk on the bond side, incrementally, looking at top tier high yield, for example, or investment grade emerging market debt. And within the stock side, we've been thinking less about the US equity market and more about other cyclical regions elsewhere, where we have a little bit more conviction that the reopening is proceeding as planned. So thinking about adding cyclical regions like emerging Asia as well as Europe. And that's actually a trend, a cyclical trend that has not paused over the past few weeks, international outperformance versus the US. So yes, adding risk, not to an extreme, and where it makes sense.
If you actually look at what the economy's been doing, Paul, yes, we're watching high frequency data week to week to see what's happening with the rollbacks, but the old data, the official data like ISM services, which were out yesterday, or the jobs report out last week, have been coming in much better than expected. If you look at the Citigroup Economic Surprise Index, which a lot of traders and investors do, it shows we're at the highs. I mean, that spike up there shows that the economic data releases are coming in a lot better than expected. So either the economists were way too negative about what this recovery was going to look like, or our economy is just bouncing back in a quick way. How do you interpret this, Paul? Does this mean that, the strength we're seeing in the market can continue?
Well, so, I mean, that chart, Citi Surprise Index, puts Tesla's chart to shame. But when we're looking at economic data, two indicators that came out last week got our attention: the ISM Manufacturing Index and the Consumer Confidence Report for June. In the case of the ISM Manufacturing, we saw one of the biggest month-over-month increases on record. And when you look at periods where you've seen high month-over-month increases, virtually all of them except for three took place very early in an economic expansion. And the three that didn't were in the last 4 months of the 48-49 expansion. Similar story with consumer confidence, although the present situation index there, when it's seen big increases month over month, that has always been early cycle since the report started coming out monthly. So I think it's a little bit of both. I think economists got a little bit negative and tried to, just like analysts on Amazon are trying to outdo each other, raising their price targets. It seems like they were trying to outdo each other, putting in their forecast for Q2 GDP, who could go lower. So we've reached one extreme of the band. And going forward, it's all going to depend on how this virus impacts confidence. And unfortunately, none of us know how that's going to be. So we just have to take it one day at a time and listen to the internals of the market here, as Mike always is talking about during his segments here throughout the day. And semis, a great indicator for the broader economy, we think, relative to the S&P 500, their relative strength at a new high intraday today. So